The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alistair McLeod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alistair McLeod, and with me I have Ron Hera, who has his own business based on the far west coast, isn't it?
Yes, Washington State.
Washington. Are you actually in Seattle?
Olympia,
and that's fairly close too.
south of Seattle.
Yeah.
It's about halfway to Portland.
Right. And tell me a bit about, I mean, you're advising clients and you're managing money really with on sort of gold, silver, natural resources. I mean, how wide does your writ run?
Well, I manage my own accounts and family money. I don't manage money for other people. And so the research that I publish in Hera Research is actually my own research for my own accounts. And what I'm covering and what I invest in is resources across the board. But I only focus on resources that I think are going to rise in value or that are rising in value because of supply and demand fundamentals and because of geopolitical factors. So I look at the macroeconomic picture and I look at the supply and demand situation for each resource. And then I look at specific companies, which I then break down by life cycle stage. And those life cycle stages are basically exploration, what I call pre-production, because I focus specifically on producers. And then, of course, the junior producers, mid-tier producers, and major producers.
Right, and so I mean, you can move from oil to gold to anything. It's anything that takes your fancy.
Yes, but of course, you've got to do the research. So
of course you have, and it's you're not going to reinvent the wheel unnecessarily and sort of move into something which you've got to learn all over again. So at the moment, we're attending a conference in Chicago, and it's hard assets, and it's mostly gold and silver, though I see that the organizers have introduced a little bit of oil this time. Shall we start with oil? Is oil something that you look at all?
Yes, I have some oil investments.
And I mean, interestingly, there's sort of big environmental problems. The cost of extracting oil through shale oil and all the rest of it is quite controversial. Are there good investments in the US, or are you looking abroad?
Well, the ones that I'm actually looking at and that I've invested in are mainly Canadian or in Australia, specifically actually in New Zealand. I think there's an interesting hydrocarbon story in New Zealand. They've got oil and coal, obviously some natural gas, and offshore potential as well. For those companies, the ones that I look at are basically conventional oil producers, but they're small producers that have the potential to increase their resources in production, and particularly to aggregate production from small wells, where they have a somewhat higher production cost than the large oil producers, but much less than shale oil or shale gas.
Right, and how does this, I mean, obviously, energy is a very, very important thing. We all need it in order to live in any comfort, particularly if you live in a cold area or in a hot area. But how does this compare with analyzing gold stocks and silver stocks?
Well, for those companies that I focus on, really they're very analogous insofar as really you can measure what the resources are, you can understand the methodology for achieving that, the resources can be increased and they can be produced. So basically, I'm looking at the same kind of growth story, whether the resource in question is oil or gold or uranium or copper. And so the way that I look at it is from the exploration standpoint. I'm looking for a resource that has significant expansion potential. And although I'm not a geologist, I also look at the geology. I look at some of the geological models, and there's a credibility factor as to what the expansion potential might be. And if I don't see it there, for example, a gold deposit, if it doesn't have the potential to be more than 1 million ounces, then I won't even look at it. So from that standpoint, I think they're very analogous because I focus on mainly the pre-production to production situations. And of course, with the decline of the market over the summer, I shifted almost entirely into junior producers that had strong balance sheets and cash flow and that had not only increasing resources, but increasing production, low cash margins, and increasing earnings. The idea being that as the market recovers, as the prices of precious metals prove to be resilient, as I expected, that then those would be the companies that would rebound most vigorously in the recovery of the market.
Yes, and there is a lot of potential gearing in the sort of stocks that you're talking about, as I would understand it.
Oh, absolutely. In fact, companies like New Gold and Fortuna Silver Mines, which I've written reports about over the summer, are doing quite well in my portfolio.
To what extent do you have an interest in physical gold and silver as opposed to mining shares?
Well, I believe strongly in investing in hard assets that are outside the financial system in addition to having conventional investments. And so I like precious metals. I also like, in particular, timberland. I like farmland, although I think it's quite expensive in the United States. And, you know, I think real estate also, residential real estate might also be good, provided you could cash flow it. I'm not saying necessarily that it would make sense to me to buy real estate at this time. It's very much a regional market here in the States.
Is there a sort of a common theme behind this? I mean, are you protecting yourself against sort of a loss of purchasing power of money, or I mean, how do you see the macroeconomic background, and how does that drive your investment philosophy at the moment?
Yeah, well, absolutely. I think that the biggest risks are inflationary risks, and that's related to problems in the banking system, problems in government finance, and obviously the central bank policy responses, which involve virtually unlimited money printing from all the major central banks, really. But I myself became interested in hard assets after the dot-com bubble crashed in 2000. I'd been in the software business and was a software entrepreneur. I started a company which I sold. And in the dot-com bubble, obviously, a lot of stocks that had been driven up by the bubble mania went virtually to zero, and many of the companies failed. And I became very interested at that time in hard assets. And so from that point, I started looking more at resource stocks and eventually got into precious metals, and then focused entirely on resource stocks after 2006.
Yeah, and you referred to central banks printing money and so on and so forth, and we've had quantitative easing after quantitative easing. I'm sorry to say, I think it was the governor of the Bank of England who invented the phrase, and it's been taken up by others. Quantitative easing doesn't seem to be achieving anything, yet we have another round of quantitative easing, which was announced last week. Why do you think they're actually doing this? Do you have any theories?
Well, there's really a couple of different problems that quantitative easing, at least in the United States, aims to address. First and foremost, QE3 is really a bank bailout. The Fed is taking mortgage-backed securities from bank balance sheets and putting them onto the Fed balance sheet, where the valuations are irrelevant, because, of course, the Fed will never sell them. They're not marked to market, and so they're basically being sterilized. And the banks are being handed cash, which improves their capital ratios, while at the same time having removed the liabilities, really, of those toxic assets. So that's how I see QE3 as, first and foremost, it's a bank bailout. Second of all, with QE2, I think the Fed had a serious problem. Buying bonds in the open market really caused liquidity to flow into speculation. And that was speculation in foreign stock markets. It was speculation in commodities in particular. It drove up food prices, and that was geopolitically destabilizing. It contributed to the Arab Spring, for example. And so QE3, I thought all along that eventually they would have to do some further easing, but I imagined that they would have to come up with a different way to do it. And indeed, that is what they have done. By now injecting money directly into the banks with QE3, they definitely have the possibility of having more of that money contained within the banking system and not having it fuel such rapid and rampant speculation.
Right. So, and do you think, I mean, it's really essentially, I think what you're saying, put another way, is it's about the collateral, if you like, that's backing the banking system. That's what they're trying to maintain. And presumably, I don't know what your thoughts are on this, presumably they're trying to avoid the Irving Fisher debt deflation spiral where falling collateral prices mean the banks call in loans, which leads to further sales of collateral, which depresses the prices and all that. So it's a price maintenance. Effectively, they're trying to maintain asset prices as high as possible, or at least not to allow them to fall. So we have both the US Treasury market and the stock market riding at pretty high levels. Can this situation be perpetuated ad infinitum, do you think? Or is there going to come a point where the Fed can no longer keep these things immune from the gravity, if you like, of the underlying realities?
Well, yes, I definitely agree that one of the components in QE3 is this idea of maintaining not just bank capital ratios and reducing the liabilities from what we know are actually mortgage-backed securities that are really not worth anything like the face value, but also to basically maintain bank capital, or bank assets.
Yeah, the collateral. Yeah.
Collateral, exactly, which obviously cash would be the best case. But another hope that the Fed has is to loan money out, that the banks will loan money into the economy. And that's the real crux of the matter because, Bernanke, for example, talked a lot about jobs. And there's really no way that the Fed is going to be able to fix the job situation in the United States. And the reason is that even if money is injected directly into banks, and even if their capital ratios are improved and they're flush with cash, and they're somewhat relieved in terms of their capital, in terms of having the value of their assets maintained, the problem that they have is really the banks can't lend into the economy because it's declining. In other words, they'll never get the money back in effect. So monetizing mortgage-backed securities in this way definitely will not help the U.S. economy in the sense of jobs.
Yeah, absolutely, because there's sort of the idea perhaps that by stabilizing the mortgage market with very low interest rates, it'll encourage people to buy houses and that will stimulate the economy. What you're saying is that that's all a bit of a myth. Because this is an interesting point, because this is something that the UK government has recently announced that they are almost relying on to try and stimulate the housing market by easing on planning regulations and all the rest of it. So we see, in this case you're talking about the Fed, but in the UK it is more the government. The authorities in general seem to be relying on the continuing development of property and so on and so forth, one way or another, as a major plank in a rescue of economic activity.
Well, they're trying to hold up the property values, but going back to your earlier question as to how long can this situation be maintained, the question itself presupposes in some sense that there's a real market there. And I think with respect to the Treasury market for U.S. Treasuries, that it's not a real market. And by that I mean that the Federal Reserve has been buying a majority of these bonds, and the Fed stands ready to buy any quantity of these bonds. So given that that's the case, until the international community and large funds reject U.S. Treasuries, which will eventually happen if monetization continues to expand and continues in the future. But until that point, which is some time from now, I believe, the bond market can be supported. Now, as for the stock market, that really is more a question of liquidity. And clearly, QE3 will help with that situation. I mean, there's really no distinction anymore between depository institutions and firms that originate securities and so forth, so brokerages. So basically, the QE3 program will also increase liquidity in the stock market. So I would expect the U.S. stock market to remain strong.
Right. Now, you're based on the West Coast. You're about as far away from Europe as you could possibly be, without being in the middle of the Pacific somewhere. Is there very much awareness on the West Coast of the problems in Europe, or is that something which is sort of on another planet?
Well, that very much depends on who you talk to. I mean, I think professionals who are working in the financial world are well aware of the European crisis and problems with the euro and so forth. But as for the general population, of course, most people really have very little awareness of what's happening outside the United States.
So, I suppose that if they awaken to the real problems that are being faced there, could that have a negative effect on their spending habits? Would it affect, as Keynes called it, their animal spirits, do you think?
Well, I rather doubt it. I don't think American consumer behavior will change much as a consequence of what's going on in Europe. However, evidence of similar problems in the United States could have a profound effect. And so that is a risk. Some of our states here in the United States are actually in deep financial trouble, and will certainly need to do some type of bailout, if not a default. And so the emergence of problems in the states of the United States that are reminiscent of problems in Greece or Ireland or Spain, if those come to light and become well known to the public, this could cause quite a bit of concern.
Yes, there's quite a lot of commonality there. We in Spain we have the various regions seeking bailouts from central government, and I think what you're saying is that there are a number of states. We're aware of California's poor finances. I think Illinois here, the teachers are going on strike and all the rest of it, and I think their finances are not very good. And New Jersey, I hear, is probably not very good either. There are a number of states facing great financial difficulties in America.
Well, indeed, the fact is that the double dip recession and the loss of household wealth in the United States, and we're currently in the second dip of the double dip, this has greatly affected the tax base. And the spread between the debt levels, and of course during the decline, debt levels have increased further. And the result of the decline plus the increased debt means that the spread between the tax base, the tax revenue, and the actual debt level is greater now than literally ever before. And this is a very serious problem because either government spending has to be cut, either taxes have to be increased, or there needs to be substantial economic growth in order to basically pull out of this double dip.
And it's very hard to see where that growth is going to come from.
It's hard to see where any of those three things will come from, because you can't get blood from a stone with respect to taxes. And obviously taxes can be raised, but the risk is that that would further deepen the recession, that could further impact the jobs market, that would further harm small businesses. So that is a problematic approach, to just say, well, we'll just raise taxes. And of course, with the social safety net being impacted as it is, as a consequence of the recession, it's a problem for governments to cut expenses as well. One of the places they could cut is in terms of public employee benefits, but obviously there's great resistance to that from public employee unions.
Indeed, and it seems to me that the fiscal cliff couldn't come at a worse time, in a sense. I know nobody's talking about that because we're in the run-up to the presidential election, but presumably the fiscal cliff is going to be a big problem in the new year.
Well, I think it'll be something of a non-event. I expect the usual political wrangling, so to speak. But I think that since we're not really... in fact, the Fed can continue to monetize debt. The United States and its allies, or I should say U.S. allies, certainly will continue to participate in treasury auctions. The Chinese very much depend on the U.S. as an export market, and given the quantity of dollars and dollar-denominated reserves they have, they certainly will continue to participate.
They've got to do something with them, haven't
Somewhat
they?
Unwillingly, they will continue to participate in treasury auctions. So I don't anticipate an actual crisis to be upon us this year. I think that the timeline for the ultimate fiscal crisis in the United States is much further out. So I think this will turn out to be something of a non-event in 2013.
Well,
2012 rather.
I very much hope you're right, because we've got too much excitement, I think, as it is, Ron. Tell me, where can our listeners find you on the internet?
HeraResearch.com. It's HERA research.com.
So it was as simple as that. Well, Ron, thank you very much indeed for taking time out to talk to me.
Thanks for having me on.
Bye.
Subscribe subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.
Oil to gold to anything. It's anything that takes your fancy.
Yes, but of course, you've got to do the research. So
Of course you have. Of course you have. And it's you're not going to reinvent the wheel unnecessarily and sort of move into something which you've got to learn all over again. So at the moment, we're attending a conference in Chicago, and it's hard assets, and it's mostly gold and silver, though I see that the organizers have introduced a little bit of oil this time. Shall we start with oil? Is oil something that you look at all?
Yes, I have some oil investments.
And Seattle?
Olympia.
Olympia, and that's fairly close too.
South of Seattle.
Yeah.
It's about halfway to Portland.
Right. And tell me a bit about, you're advising clients and you're managing money really on sort of gold, silver, natural resources. How wide does your writ run?
Well, I manage my own accounts and family money. I don't manage money for other people. And so the research that I publish in Hera Research is actually my own research for my own accounts. And what I'm covering and what I invest in is resources across the board. But I only focus.
The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alistair MacLeod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alistair MacLeod, and with me I have Ron Hera, who has his own business based on the far west coast, isn't it?
Yes, Washington State.
Washington. Are you actually in?
On resources that I think are going to rise in value or that are rising in value because of supply and demand fundamentals and because of geopolitical factors. So I look at the macroeconomic picture and I look at the supply and demand situation for each resource. And then I look at specific companies, which I then break down by life cycle stage. And those life cycle stages are basically exploration, what I call pre-production, because I focus specifically on producers. And then, of course, the junior producers, mid-tier producers, and major producers.
Right, and so you can move from. Interestingly, the sort of big environmental problems, the cost of extracting oil through shale oil, and all the rest of it is quite controversial. Are there good investments in the US, or are you looking abroad?
Well, the ones that I'm actually looking at and that I've invested in are mainly Canadian or in Australia, specifically actually in New Zealand. I think there's an interesting hydrocarbon story in New Zealand. They've got oil and coal, obviously some natural gas, and offshore potential as well. For those companies, the ones that I look at are basically conventional oil producers, but they're small